Okay, chapter 6, and in this chapter we're going to talk about getting more familiar with stocks and all the facts and figures and information about how stocks work. So we're going to talk about why people love to invest in stocks, the types of returns you can earn in stocks and historical returns, the basic features of stocks and their characteristics and their costs. We're going to look at different types of common stock values, discuss dividends, types of dividends, dividend reinvestment plans, and we're going to look at all types of common stocks, foreign stocks, how stocks can be utilized in investments. We'll look at different blue chips, small caps, large caps, medium caps, things of all this nature, all different types of stocks. But as a country, we love stocks, and everybody likes the concept of owning stock or investing in stock, or the idea of, I think it's because we can buy and own a small piece of a company. So we can actually partake in the increases in that company's sales and profits and be, closer to the action. And it's an exciting thing to own stocks. We can get capital gains. We can get dividends. It's just something that keeps paying us, and it's always, and historically, over the long term, beat inflation, has had the best returns. The stock market is very diversified as far as what companies are available, what you can buy, so it allows you to really customize and tailor an investment portfolio because there's so many stocks out there. You can design a portfolio that provides a steady stream of dividends, design a portfolio for aggressive growth, and the increase time, generally, if you pick relatively decent stocks, those stocks are going to increase over time, especially if you have a very diversified portfolio of stocks. And if we look at, here are some historical rates of return. One thing, the rate of dividend return, in the average rate from 1950 to 2010 is 3.6%. In the 2000s, the rate was much lower, but since then it has been coming up strong as more companies have been making record profits and deciding to pay dividends to investors. As far as return on capital or capital gains, we sort of had this lost decade of the 2000s. We had two major stock market declines in the 2000s. 2000 to 2001, we had a huge decline, stock market crash. And in 2009, we had a 50 up to 55% or so decrease in stock market value, really the lost decade of investing. Now, in the 90s, the decade preceding it, we had a great decade that had averaged a huge amount of average returns. The 80s were not bad either. The 80s were another great decade. So we had 20 years of just phenomenal, consistent stock market returns. The 70s were terrible, a lot like the 2000s. So let's hope that the 2000 teens and 2020s will be sort of like the 1980s and 1990s again. The total return from 1950 to 2010, historical return for stocks, is 7.2%. Before the 2000s hit, that was closer to 12%. 1950 to 2000 would be closer to 12%. So we lost a lot of traction in the 2000s. So total return is you want to add your dividends and your capital gains together. So the total average returns of dividends and capital gains from 50 to 2010 is 11% return. It's better than bonds, bank accounts, money markets. That's why people like to invest in stocks, because we can beat inflation and we can get the best return over any other financial instrument that is available to a common investor. Okay, so if we look at this chart, this is home prices and stock prices. Okay, so the red line is the stock prices, the blue line is the home prices. So you could see that from 2003 to 2007 or so, home prices and stock prices were going up in tandem pretty quickly. So we had a nice bull market, and we had a nice increase, bubble in housing due to low interest rates. And then it got to a point where there was a frenzy. Money was thrown at everybody, many people who couldn't pay it back, and you know this whole story. And the housing prices declined, and the stock market declined even faster. And this is that 50% I'm talking about. We were at 1,500 and went down to under 700. I think like 666 was the level we reached. Now, since then, the stock market has rebounded a lot quicker than housing rates. So housing prices have not increased much since 2009, while stocks have gone up 100%. So that's why people are saying the U.S. housing market is not in a bubble, clearly, but the stock market may be in a bubble. And that would be, you know, an interesting time to see what happens. Does this, you never know, sort of like blowing up a balloon, right? Ever blow a balloon up and you start to fear you're blowing it up too much, it's going to explode in your face? So you're never quite sure where to stop. But for me, I'm always surprised how much more, sometimes I just go for it. I'm going to blow it up until it blows up my face. How much more air I could fit in there, how much bigger it could actually get before it reaches that critical point. So right now we may feel like the balloon's pretty full, it could pop, but there could be 3 years more of people blowing hot air into it before it actually does pop. But the bigger it grows and the more violent the pop will be back into your face when it actually does pop. So that's why I wouldn't, you know, say for someone to take all their money out of the stock market, because you could have 2 more years of 10, 20% gains before this does explode as a bubble, you know? So it's hard to really say when that's good. I mean, I thought, you know, many people thought in 1997, 1998, the bubble was going to burst, but they had 2 more years of spectacular gains before it really did blow up. Now, if we do talk about stock market returns, you want to take into account, like I was saying before, the dividend income. So, I mean, capital gains, average annual capital gains for stocks can range from, say, 15% to a negative 2.7% on average for decades. So that's a pretty big diversion. I mean, there are some years where we had this last year, the S&P gained like 30%. That was a phenomenal year. But there are some years where the S&P goes down 40%. That's just in 1 year. We're looking at decades. That's why it's a little bit smoother, those numbers. But dividends vary too. Sometimes they're in favor, and the tax legislation makes them favorable, and investors are happy with dividends. In the one reason the dividends were lower in other decades is that they were taxed very heavily. So investors wanted the companies to either buy new companies, reinvest it in the company, or buy back stock. All right. So the name of the game for stocks is long term. The longer your investment horizon, the better your chances for making a decent return. So being invested in stocks for only a year can be quite risky, but being invested in stocks for 40 years is clearly not as risky. So for you, if you have 40 years till you retire, stock market is where you want to put your money historically. If you put all your money into a savings account in a bank, it's not going to grow. It may be safe, but you're going to fall behind inflation, and that's the reason we love stocks so much. Okay. So let's talk about this potential decline in the stock market. As we saw in January when the class started, that I should say when the year started, that stocks declined about 9.5% or so. And then in February, stocks rebounded, returned all the losses of January. So March and April looked to be turbulent months, and May and June probably back to a little bit normal consistency of returns that, you know, June should be a halfway decent month after the turbulence we're feeling right now. But it's a routine decline in the stock market of 5%, happens every so often. It's just some bad news comes out, some world news or terrorist events or just some economic news, and the stock market, people want to, what they call, they want to collect their profits, and they'll sell and the market go down 5%, and routine, nothing to worry about, because that could just be a momentary news. But a correction is a drop of 10% or more. Now, that is a little bit more serious. So a correction is really people to stop and say, okay, things are getting overheated. The PE multiples are too high. This is not realistic at all. I think I'm going to sell and collect my profits and then wait. And that's, typically a correction phase. And then once things have corrected, some stocks correct more than others, then people go back into the market. Now, a bear market is a 20% drop or more. And this is a significant, usually a significant economic force behind it. So inflation is going up, unemployment rates are going up, growth is negative, a fundamental change in our business cycle from growth to decline. And that is generally what causes a bear market, and the bear market will stay with us until the stock market realizes the economy is changing, and then stocks will grow again. And one thing that we can be that's always consistent is that the stock market goes through cycles of bull and bear markets every so many years. I mean, bull markets usually run between 3 and 5 years, and bear markets 1 and 2 years. So you can have much longer bull markets and much longer bear markets. It all really depends on the economics behind it. So if the economy is going to improve, we're going to go into a bull market. If the economy is going to deteriorate, it's going to result in a bear market. Okay, so let's talk a little bit about stock ownership. We want to own stock because, one, it makes us feel affluent. Like, look at me, I'm middle class, I own stock. I'm not the 1%, but I'm rich enough that I can actually afford to invest in stock. So it makes us feel good about ourselves, that we're not, poor. Well, we may be, but owning stocks gives an illusion that we're doing well. So, and we like the opportunity to get higher returns than any other investment, especially now. And that's one of the things they're saying that could be fueling this bubble, is that there's no really good place to put your money to earn a decent return. So stocks are the one place where there are returns. You're not getting, in most cases, housing is not returning a spectacular amount. Bonds aren't, bank accounts aren't. So we want to put our money where it's growing. And that's why a lot of money has been flowing into the stock market. And while they're worried about the Fed completing its taper and raising interest rates, because that will make other investments more attractive, and that means people will pull money out of the stock market. And it's sort of like this herd mentality. Once the stock market starts going down and people start pulling their money from it, everybody starts to follow suit, and it sort of creates a chain reaction. But over the past 100 years, U.S. stocks have earned annual returns that are double corporate bonds, are better than any other investment that you could invest in. It's a great hedge against inflation. So if you want to protect your money in your retirement or your savings from inflation, you have to always earn more than inflation. It's for anybody, this day and age, it's very easy to buy and sell stocks. You can open up a brokerage account online in less than 10 minutes and begin trading. It's just we saw from chapter 3, there's plenty of websites and different brokers that you can just easily online create an account and start trading. Now, with the internet as detailed as it is today, even just one site, Yahoo Finance, I mean, there are many, many more sites, including Google has a finance site, that's going to give you all the market data information that you need, very easily to find, quick, and just as fast as anybody else. And because the commissions have gotten so much lower, you can get a share of stock with commissions I've seen as low as $7. Some promotions will give you free commissions for the first 60 trades. So you can get, the cost of ownership is very low. Commissions used to be over $100 a trade. So you really wanted to make a large trade and didn't trade very often. That's a lot of money. Now when it's so low, it almost encourages people to day trade, and that's what they really want. These brokerages want you to trade more. So they learn lowering the commission rate encourages you to trade more, and they'll make just as much money from you because you'll be more inclined to trade a little bit more frequently. Now, it's not all sunshine and smiles. There are some disadvantages to stock ownership. And as we talked about in the previous chapter, there are many risks associated with stock ownership. You got your business risk, financial risk, purchasing power risk, market risk, event risk. These are all things that which we talked extensively in the previous chapter, which will affect the value of your stock price. And the riskier the stock, the more potential you have for that to go down quickly. But it's really hard to predict the price swings or where. This is the only hard part of investing in stock, is predicting when the stock price will go up accurately. You know, you may have a good idea and you invest in the stock, but then the stock price goes down. So you get discouraged and you sell it. You know, so you bought Tesla at 35, or maybe you bought Tesla at 45, it went down to 35, you got discouraged and you sold it. Then 6 months later, you look on the internet and you find it's over 200. Where did I go wrong? Well, you weren't patient. Investing in stocks is a game of patience, not a game of day trading or trading rapidly. I mean, you can make some money doing that, as clearly, but for the most part, if you do your analysis and you know the company is good and it has a good future and the product's solid and you keep your money in it and you add to it, over time you'll be proven right as long as your fundamental analysis is correct on the stock. And we'll talk about fundamental analysis more in the next chapter 7. But if you do the homework and you find a good company with a good product and a good stock and good management, over time you'll be rewarded. But in the short term, anything could happen. And generally with stocks, you're in it for the capital gains, not the short-term income from dividends. Dividends are nice and it's nice to have, but for most stocks, the money's really in the growth of the stock price, not the dividends. All right. If we look at the coupon on bonds and the dividends on stocks, you can see that by and large, bonds pay more in dividends than stocks. Although today, they're much closer than historically they have been in the past 35 years. And you could see in the 80s, interest rates were very high. I remember having a bank account where I got a 5% return on my bank account. Just a simple bank account. And bonds were up to, at the height, 14%. And dividends were getting close to 6%. But as inflation has been tamed in the 80s and 90s, and interest rates have come down, both bonds and stocks have been yielding less. So in today's world, especially if you look at, these are really more rates on corporate bonds, but if you look at Treasury bonds, they actually have yields lower than most dividends on, say, the S&P 500. So that's why a lot of people are saying, well, why would I want my money in Treasuries to earn 2% where I could have my money in the S&P 500, get the capital gains of 30% last year, plus, you know, a higher dividend return of 3% or so. Okay. Let's talk about just some basic characteristics. Equity capital is the money companies get from stock. It's ownership in a company, and sometimes when we call stocks, we'll call them equities. So if you watch like in a news show and they talk about equities, a change in equities today, they mean stocks. If they say fixed income securities, they mean bonds. It's one way we try to keep finance confusing by making multiple names for the same thing, so it seems confusing and people want to pay for an expert to help you with it. And of course, stocks are publicly traded, which we talked about IPOs before, and they're available in the general market. Anybody can buy them, you know, anytime. Sometimes stocks will make additional offerings. They will issue stock once, but then later on do a follow-up issuing, and they may do another public offering, which is basically selling more stock. So a company, when they sell stock, they don't sell 100% of their company at once. They may sell 15% of their company to investors to invest in stock, and they own the rest of it. So at a certain point in time, they could break off more of their company and sell more of it. You know, so it's up to the company to decide how much of their company they want to sell as equity and when they want to issue additional shares. But the problem with issuing additional shares is now there's more outstanding shares and your percentage of ownership decreases. That's why they'll sometimes do what's called a rights offering, which is, say you own 10% of a company and they want to issue more stock. They'll give you the right to buy enough additional shares of stock to maintain your 10% ownership in the company. So if they're going to expand the stock by 10%, then you'll probably have to buy 10% more of the new issue, or 10% of the new issue, to maintain your 10% of ownership. And that's important to a lot of investors who have voting rights and who have certain controlling interests in the company. Stock can also do something that's similar to TV shows. They can create a spin-off. So do you know the show NCIS? Am I saying it right? They have a spin-off that is NCIS Los Angeles, and they're making a new one next fall starring Scott Bakula, which I'm not sure what city he's going to be in, but he's going to have his own spin-off. And you have the CSI spin-offs, Miami, New York, and the original, which I think is in Las Vegas. So why do TV shows do that? Well, if you have a hit brand and you have you can easily create a second entity that's going to be equally liked. Why not? And and the same thing for companies. If you have a big company and they have parts of their company that they can easily spin off into another stock, they do it. All our phone companies today basically came out of Bell, or Ma Bell as you used to call it, and they spun off all the regional phone companies like Verizon. A lot of them have since merged back together. There's a I'm trying to think of some other good examples. Philip Morris recently spun off Kraft Foods off their company and created a separate stock. So if you owned a Philip Morris stock, and the next day you woke up, you had Philip Morris and Kraft. So sometimes big companies will take a division of their company and say, you know what? And Barnes & Noble was thinking about doing this at one point, not anymore, but they wanted to break off the Nook and make that its own company and spin it out as its own stock, because they felt that stock would appreciate a much faster than the brick and mortar bookstore. So sometimes they want to break off a hot piece of the company so that it's not held back by a slower business aspect of the company. Sometimes, so stock spin-offs are common, but not excessively so. You may only get a few in your lifetime, but each year there are a few companies that will spin off a division or a part of their company as a stock spin-off. Now, you don't get any, generally what you might see is you might have a $100 stock and they spin off another company that trades at $25, but the company it's spun off for is going to be at $75. So it's not like you're going to initially get any additional value. It's only later, if that stock price of the spin-off increases, then you may get some additional value from that as that increases in value. And stocks can also split. So a stock split, you're again not getting any money. You're getting more stock, but at a lower price. So I'll give you the option. What would you rather have? 100 shares at $100 or 200 shares at $50? Doesn't matter. It's the same. 100 shares at $100 or 200 shares at $50, it's the same value. Would you rather have 10 shares at Google at $1,200? Yeah, it should be the same in the math. 200 times 50 should be the same as 100 times 100, no? So same value. Would you rather have 10 shares of Google at $1,200 or 100 shares of Google at $120? It's 100 shares at 120? No. 10 shares at 120? No. 10 shares at $1,200 or 100 shares at 120. Should be the same amount. It's the stock. The point of it is stock split. They don't really give you any extra cash. They're just splitting the stock in half. So you have 100 shares in your account at $100. The next day you wake up, you have 200 shares. Like, oh wow, I got 200 shares, but wait, they're only $50 now. But the total amount of value in your account's the same. So why do companies want to split their stock? Yeah, it's a psychological thing. If a lot of people buy stock like they're buying clothes, and they say, if you were going to buy jeans, right? Would you buy jeans that cost $200? Would you buy jeans that cost $35? Yeah, that seems more reasonable. It seems like jeans should be cost somewhere between $35 and $50. People look at stocks like that way. Oh, I'm not going to buy Google. It's $1,200. I'll buy Facebook. That's only $70. But the truth is, Google could be a $70 stock too if they split it the right way. If Google could do a 10 for 1 split and get this, or 20 for 1 split and get their stock down to about $60 a share. But there's really no difference because it's still the same value, still the same market cap. Although many companies do continually split their stock because there's more demand for stocks that have a price between $30 and $50 per share. People feel more comfortable buying a stock at that price range. A lot of people will not buy Google because it's $1,200, or Chipotle Mexican Grill because it's $300, $500. It keeps going up so fast I lose track of how much it is because it's just too big. But if they were able to do a stock split and it was only $50 a share, more people, the demand for the stock would go up. And that's why companies like to split their stock, because it's keep it at a more attractive price. And if, as an investor, I have to say there's nothing better than a stock splitting at 100 back down to 50 and then moving back up to 100 again to split again. Cisco did that 11 times. That's why that was a phenomenal stock, because it kept Microsoft did that a number of times as well. It kept going up and splitting, going up and splitting. So predict that when a stock gets a reputation for doing that, it increases even more people to buy the stock because they want to participate in that. But in the end of it, they're really just a numbers game. They're just giving you more shares at a lower price. And stocks should do a reverse stock split as well. And this is when certain companies have done this. When the stock price gets too low, they're going to get kicked off the exchange. So they may do a reverse stock split. Say the stock's trading at $1 a share, they can do a 10 for 1 reverse split, and now it's going to trade at $10 a share. But in your account, you had 100 shares, now you have 10 shares. Investors hate that. When you do a reverse stock split, a lot of people want to sell the stock or get out of it because they feel like they're losing something, because psychologically they have less shares, but it's the same money. But typically, only stocks in trouble do a reverse stock split. Okay. Treasury stock. If a company goes to buy back its stock, it's going to place that in the equity section of the balance sheet under an item called treasury stock. So it's a stock that the company owns. So companies can own their own stock. So when they do a buyback and they repurchase their own stock, they're going to own it. And they can actually reissue it at a later date to the public. But if they repurchase it and becomes treasury stock, the amount of outstanding shares to the public is reduced, and earnings per share, revenues per share are increased. So if a company believes that their stock price is undervalued, that might be the best investment they can make, is to buy back their stock. And then investors feel a little bit more confident about the stock. If the company is buying their own shares, it must be a good deal. And it generally raises the value of stock altogether for the company. Now, these treasury stock, companies can utilize that to buy other companies. So if there's going to be an acquisition, companies can use the power of their treasury stock to pay for an acquisition and pay the other company's shareholders in stock. And then they can offer, we'll give you 2 shares of our stock for 1 share of yours, and if they agree to it, they've purchased the other company through stock. And we mentioned Cisco before. Cisco stock was so powerful that they purchased hundreds of companies on stock deals, no cash, just trading their treasury stock for other companies. So it gives financial managers many options. So everybody likes to buy back their stock because it gives them a pool it lowers the amount of outstanding shares, which improves all their financial metrics, makes investors happy, tends to increase the price for the extra demand, and then they can utilize this treasury stock to sell back if they need to raise capital in the future, or use to buy other stocks in an acquisition. Now, stocks can be classified at different levels as well. You can have your A classification, your B classification, your C classification, and it just means that there's different voting rights generally between the different classes. So, for, a good example is the Ford Motor Company had a B class of stock that the family owns, which gave them stronger voting rights than people who owned the A class. And what that allowed them to do is they didn't have to own 51% of the company to control the company. So if they give their stock class a higher voting right, they may only have to own 20% of the company, but still have voting control of the entire company. So that's one reason for having different classes. There could be different dividend schedules. Certain classes of stock could have a preferred dividend attached to it. So although this isn't that common, some stocks, especially blue chip stocks, tend to have different classifications, and you may want to look into that before you buy them. Okay, so here is this stock quote from Yahoo, and you could see that this is a clothing outfitter, and that this is. Do you think the stock is trading higher or lower than when this snapshot was taken? Okay, let's see. Ooh, this must. $39. So it's a little bit higher. Okay, so it's about $4 higher. So this stock has gone up. The PE here was 34, and here it's the PE is 56. Earnings have actually gone down, which is a P multiple 56 for a real retailer. Again, for me, remember I said 50 was a scary point for PE. For a clothing retailer to trade above a 50 PE is just more evidence of a bubble stock market economy, because we've all been here. The store isn't that good. That should be trading at 50 times earning. I mean, it's no Banana Republic. Which is actually, what company is Banana Republic a part of? Yes, he's wearing the sweatshirt right there. It's a Gap company. Gap, Banana Republic, Old Navy. So it's sort of like Old Navy if you don't have any money, Gap if you kind of have some money, and Banana Republic if you want to waste your money, Okay. Now, if we talk about transaction costs, you want to be careful of your commissions. So you don't want to buy stocks in small amounts. You want to buy them at least 100 shares at a time, if not 500 or 1,000 shares, to get the maximum, because it's the same commission. $7 or $10, maybe $15, whether you buy 100 stocks, 1,000 shares, or 500 shares. So buying in odd lots or lots smaller than 100 is going to increase your transaction costs. And frequently trading a stock, buying and selling it, feeling like, oh, it made a few dollars, let me sell it, and I'll buy it again when it goes down a few dollars, and that's going to increase your transaction costs as well, and may even, exclude you from, you could sell the stock when it's moving higher and wait for it to move lower to buy it, but what if it just keeps moving higher? Now you just eliminate all the top end ability of returns on that stock. Okay. All right. So we look at stock values. This par value is an accounting stipulation. It's a face value. It's an accounting term. It has no real connection to any valuation or real value of the stock, and most times the par value could be stated as $1. So par value, as far as stock value, is just an accounting statistical technicality. It has no real connection to investing or valuation. Book value is something that is more connected. Book value, which we talked about, is looking at the equity of a company, so the more equity the company has, the less liabilities they have. So assets minus liabilities gives us an idea of what the book value of a company is. So we like companies who have a book value that isn't negative, that has a book value that is at least half of what the stock price is. So book value per share For a $50 stock, we feel comfortable if it had a $25 book value. If a book value is ever higher than the stock price, say the book value is 50 and the stock price is 25, there's a problem. Because companies usually, functional, profitable companies always trade above book value. So if there's a company trading below stock price below book value, there's a problem. It's probably a lawsuit or a declining market. There's some reason that investors are turning away from that company. Market value is another way of saying stock price. So when you see market value in any of the homeworks or any the readings, they're really talking about stock price. Stock market, market value. See the connection? Okay. Market capitalization. Again, this is the total sale price of the company. So if you were to buy Yelp, you're paying close to $7 billion. TripAdvisor's $12 billion. Because that's the outstanding shares times the stock price. So that's the total cost. If you wanted to own that company, you bought every share of stock at the same price right now, that would be the market capitalization. It's what the value the market feels the company is worth. Now, investment value is something different. It's what you think it's worth based on financial analysis. So looking at a company and trying to figure out, if I'm looking at Yelp and I'm seeing $7 billion of market cap and $250 million worth of sales and no profits, I'm thinking the investment value isn't $7 billion. I'm thinking Yelp is probably about a $2 billion company. I'd be comfortable buying Yelp at a $2 billion market capitalization because that's my investment value I would place on them. So if I see it trading at $7 billion, or between $6 and $7 billion, I'd say it's overvalued. The market capitalization, people are paying way too much for the company compared to what I feel it is worth. But you know what? Sometimes investors don't care and they just keep pushing the stock price up because it's in the news, it's a hot stock, it's a growth opportunity. It just kind of, sometimes it's a self-fulfilling prophecy and the stock keeps going up to a point where it can crash. If they don't live up to expectations, if there's a slowing of their sales rate, if there's a delay in their earnings, it can completely crash the stock as people see that this stock is just not a wonder stock anymore. It's like every other stock. It's going to have good and bad times. Okay, so if we're talking dividends, and we know that this is the other side to return, we have our capital gains and we have our dividends. And dividends are taxed at 15%. They have a special tax status. And dividends can be, some dividends are tax-free, some dividends are qualifiable, some dividends are considered ordinary. So some dividends are taxed at different rates. But by and large, for the most part, you're going to be paying 15%. And that's one reason dividends have increased over the years is because the taxing situation has gotten better. So it used to be that you'd pay 20 or 25% or your full income, whatever your marginal tax rate is what you'd pay for your dividends. And that's why companies was discouraged for giving them. But now that they had a better tax advantage on them, dividends have started increasing. Now, if you are a high earner, I'm not sure what the threshold is, you will have to pay 20% on your dividends. Depending on, there's some new rules, some changes in the tax rules, and they have increased the taxes that the rich pay on dividends because they feel that, the rich should pay everything. They're the ones that are rich. Why shouldn't they just pay for everything? So they've changed some of the tax laws to make that closer to truth. Now, if companies' earnings are growing and they're paying a dividend, they generally translate to increasing the dividend. And it's a return of money to you that the company makes. So if a company makes net income, there's only two things they can do with it. They can pay it out as dividends or save it as retained earnings. So if the company makes profits, they can keep it and reinvest it in the company by expanding the company, buy more locations, buy another company, or they can pay it out into investors as a dividend. And it leaves the company and it goes to you as an investor. And that's one thing with Apple. They had so many billions of dollars of earnings in the bank, doing relatively nothing, that it had so much money they weren't really sure what to do with it. Investors kept saying to Apple, give it to us as a dividend. If you're not going to, buy back stock with it or buy another company, give it to us as a dividend. Same thing with Microsoft. When Microsoft was in its heyday, it had, billions of dollars in its cash accounts, and investors were crying so much they finally did a special dividend of $3 a share, a one-time special dividend of $3 a share, and now they pay an annual dividend to investors because they ran out of things. Once they set up and established Xbox, because they paid a lot of money to set that company up, they were really limited through antitrust to buying new companies. So they really had, unless they wanted to go in a completely new business direction, they're limited to where they could spend all their profits. So they couldn't just buying any other company was dangerous for them because of the monopolistic lawsuits that they were involved in at the time. Okay, so there are some dates for dividends that you should be aware of. There is the date they declare the dividend, which is obvious. They just make an announcement, hey, we're going to pay a dividend. Now, there's what's called an ex-dividend date and a date of record. So if you want to get paid a dividend on, say, the 30th is the day they're going to pay the dividend, you are not going to get this dividend that pays out on the 30th. They announced on June 3rd, we're going to pay a dividend on the 30th. If you bought the stock on the 29th, the 28th, the 27th, 6th, 25th, 24th, 23rd, 22nd, 20th, or 19th, you're not going to get the dividend. You need to own the stock on the 16th. Because the 16th is the day at which the dividend, the ownership is going to leave, ownership of the dividend is going to leave the stock. So it's only going to be paid to people who own the stock on the day of the 16th. Because it takes 2 days to record that you own the stock on the 16th. Because when you sell stock, there's a 2-day transactional period that you have to wait. So the data record's actually the 16th. So you need to own the stock on the 16th to get the dividend on the 30th. If you buy the stock on the 17th, 18th, or any day after, you're not going to receive that dividend. If you sell the stock on the 15th, you're still not going to receive the dividend. So there's one day, the ex-dividend date, that you want to own the stock that full day and have your name recorded as the owner of the stock to get that dividend. So if you're going to buy a stock that pays a dividend, make sure you know your dates of when the dividend is going to be recorded, the ex-dividend date, and then when you're going to receive the dividend. Okay, so earnings per share, we talked about this before. It's just a formula, profits minus preferred dividends divided by outstanding shares. And it shows in a per share level how much earnings your one share of stock is worth, is generating. So the more earnings your stock generates, the better the stock is, the more profitable the stock is. We like that. We talked about dividend yield, and again, that is simply the annual dividend the stock receives by the market price to give you a yield, a percentage, so you can compare it more easily with bonds. What percentage yield does my stock pay compared to my bonds? And the payout ratio, again, is just looking at what percentage of my earnings per share is being paid out as a dividend. So if a company pays out 25% of their earnings and they make that policy, earnings double, your dividend will double. Okay, I'm going to stop here and we'll continue this in part 2. We'll talk about dividend reinvestment plans because there's a little bit more. I can't finish that in too quickly. Oh no. Oh shit.